Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of New York and London sugar markets. I'll start with ice raw sugar in New York. The recent overall bullish incentive has hobbled all endeavours and patterns attempted to move lower. This bullish incentive is exemplified by the middle and upper times, currently 1807 and 2032 respectively, of December 2020 to April 2021 bullish shift pitchfork. Now, as you already know, I am the first to say that there have been some aberrations guiding the market higher, since April. However, these two tines have been consistent in their bullish angle of attack and outlook. They have, on a tactical level, combined with the April 2021 today uptrend currently at 1925 and the rising medium moving average currently 1916 and guided prices higher. They have also, since mid-August, started to erode the heavy-duty overhead resistances we can see above, still see above. These resistances are the same overhead resistances that we saw back in that double top in August and ever since. Notably, the heavy congestion from January to February 2017 between 2010 to 21 even, and the upper tine of the broken upper tine of December 2020 to April 2021 shift pitchfork. That's a bullish shift pitchfork. Of the two resistances I stated 2 weeks ago and reiterated last week that the former is the stronger, I still stand by that. Meanwhile, the nearby support below is the same as it has been in September and October and consists of the previously mentioned rising supports plus the February 2021 high at 1894, with now the late September based uptrend currently at 1935 as a new rising wedge type trend line. Last week the market took the first 3 and a bit days in rising to test the overhead resistances, and the remaining day and a bit in pulling back down in disappointment, as all that prices had managed to do was make a single close over December 2020 to April 2021 bullish shift pitchfork upper tine, before coming all the way back down into the core of what is increasingly looking like a rising wedge pattern. It only managed to emphasize what I have been saying now for weeks, months even, and I quote, "This market has what looks like elements of a market being squeezed, but with still plenty of room to maneuver. Just be careful of the downside for the moment." End of quote. That was then and this is now, and I'd add this additional comment from last week. I quote, "The room for maneuver now is getting significantly, very, very significantly less than it was then. Watch out in case all gets squeezed too much." End of quote. Ice Europe white sugar. First off, what I once acknowledged many times as being put off the top of the daily chart has now, due to the market's movements, entered the frame. On the top right of my daily chart, it was to regard the whole of the September 2020 to date action as a huge possible bull flag, with potential topside target X2 in the 560 area. This was, though now maybe no longer is, a very big ask of the market. However, I had qualified it all by pointing out that as other targets had been achieved, it seemed appropriate to keep this one in mind, just in case. Even as recently as 2 weeks ago. I was minded then to retire this target, as I thought the market's pattern may have changed enough as to no longer make it valid. Now, whilst Monday last week's high was the highest we've seen since March 2017, and directly threatens the overhead gap from March 2017 between 531.70 to 532.70. As I said, I'm minded to think the idea of a bull flag is no longer to be valid. So why should I have a target up there in the first place? I will ponder on this a little more. However, overall, the market continues to nicely move up and around the middle tine, currently 531.5, of the early August to early September bullish shift pitchfork, though last week's combined bearish dark cloud cover pattern and possible bearish double with the resultant moves lower now threatens a test of the lower tine, currently 501.70. Today the market dropped down to test the rising short medium moving average, currently 507.90. That's the first time it's been tested since late October and the first proper breach since early August. Now I am still minded to think of the middle time as a market attractor of sorts, even now. But I have to say, today's move lower through the short medium moving average is making me question that idea. This is because, as I said last week, I thought we had the beginnings of a possible rising wedge pattern, or a bull channel. This pattern was made up from the upper trend line, currently 541.70, of the connected highs from August and October, making the upper side. And as I said last week, the lower trend line for this is still obscure, and the best I think I can give for this is the rising short medium moving average. Even this one is just a suspicion and not necessarily one I would be wedded to. End of quote. So where do we stand? There is no definitive lower wedge or bull channel trend line. That's the problem. There is no definitive one we can really draw. And the breaching of the rising short medium moving average very much affects the integrity of such a pattern, as I've been minded to think of that as being a sort of a dynamic version of the trend line. I'll be therefore very interested to see if we close below the short medium moving average, by how much as well, and if we can repeat such a move. Sugar white premium spread. As said last week, and I quote, "This is to me by far the most interesting of the sugar charts this week." I'll explain what I mean. Remember, this is from last week. So 4 weeks ago we had a bearish dark cloud cover pattern. This was followed 3 weeks ago by an immediate countering bullish double. This was followed 2 weeks ago by a counter to the counter key reversal down and bearish engulfing pattern. Then last week we had a third countering key reversal up and bullish engulfing pattern. End of quote. In all that time the ranges have become wider. This was not halted last week as the market made a fourth countering pattern. This time it was a fourth countering bearish harami. So what does it tell us? Well, pretty much what I've been saying for a couple of weeks now. It is obvious from all this action, this market is hugely indecisive. Not just on an intraday level or an interday level, but on an interweek level. The one feature in all this that has managed to maintain its integrity has been the middle time, currently at 67.75. The broken big bearish May 2020 to February 2021 shift pitchfork, the bearish shift pitchfork. As a falling but still solid support to a certain degree. One could also say for last week that the upper time, currently at 96.25, also managed to exert pressure on top when it was approached. Again, last week. All the moving averages, bar perhaps a short medium moving average, currently at 73 even. Even the 50% Fibonacci lines at 82.75, 80.25 and even 73 3/4. All these have fallen to the wayside compared to the bearish pitchfork's middle time. We now need to look once more at the middle time again this week to see if after all this testing, these past 5 weeks, if it can still act as a rolling bearish support. What is also interesting now is how the middle time, which is now approaching the flatlining medium moving average, currently at 63.5, will react if they meet, and what the market will do with this seemingly strengthened middle time. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.